Now, we know how to translate a financial statements from the foreign currencies to functional currency. So when we translate from the foreign currencies to functional currency, we call this temporal method. We can also translate a financial statement from its functional currencies to the presentation currency. If we translate a financial statement from the functional currencies to presentation currency, we call this cost and weight method. However, translation of the financial statement of a foreign operation is just a translation of one of the three components of the investment value. We understand that always investment values include three components: book value of net assets, fair value adjustments, and the goodwill component. The financial statements of the foreign operations will show only the book value of the net asset. On top of the book value of the net asset, we have to translate also the fair value adjustments and also the goodwill component. Under Hong Kong Financial Reporting Number 3, goodwill arising from Hong Kong Financial Reporting Standard Number 3 business combination should initially be calculated in the functional currencies of the foreign operation. So, if you have got a UK subsidiary, if the functional currencies of that UK subsidiary is UK pounds, then goodwill should be recorded in the functional currencies of that foreign operation, that means UK pounds. But if the functional currencies of that foreign operation is Hong Kong dollar, we should record the goodwill in Hong Kong dollar, being the functional currencies of that foreign operation. And this goodwill should be treated as an asset of the foreign operation. In other words, it should be kept in the functional currencies of that foreign operations. The same applies for the fair value adjustments. Of course, we will keep the fair value adjustments in the functional currencies of that foreign operation. So therefore, how we translate the goodwill and the fair value adjustments depending on the functional currency of that foreign operation. Here we have got an example on how we translate goodwill and fair value differentials. Here, S, whose functional currency is dollar, acquired the entire share capital of P. So in this case, S is the parent, P is a subsidiary. So this P is a foreign company. How much we pay? We pay 2 million. At the day of acquisitions, these subsidiaries pay up capital and retained earnings were denominated in FC 3 million and FC 500,000 respectively. So they are being denominated in FC. The assets and liability of P at the day of acquisition by S approximated their fair value except for a building. So therefore there is one fair value adjustment which is related to a building. The building has been undervalued by FC 100,000. Being undervalued, this means there should be a fair value increment. There has been deferred tax liability in relation to this building, 20,000 FC, that means 20% tax rate. The exchange rate on that day, at the day of acquisition, was 1 FC equals to $0.50. This is the situation. Because we got all this information, we can start to calculate goodwill. Goodwill is what we pay minus what we get. The cost of investment is $2 million as recorded by the question. This is what we pay. What we get is the fair value of the net asset. On that day, the book value of the net asset is 3 million share capital plus 500,000 retained earnings. So the equity is 3.5. So this 3.5 is the book value of the net asset, but on top of which there has been a fair value increment. After tax, this is 80,000. So therefore the fair value of the net asset is share capital plus retained earnings plus fair value increment after tax, altogether 3.58 million. On that day, this is recorded in FC, but we want to calculate the goodwill now in dollar. Therefore, FC should be translated into dollar, and therefore this is $1.79 million. So in terms of dollar, goodwill is 210,000. This is how we calculate goodwill. Of course, we can directly calculate the same using the journal entry. On the day of acquisition, we credit away the investment in subsidiary, $2 million. We credit the investment in subsidiary, $2 million. This is 100% subsidiary, therefore there's no NCI. So we debit away the share capital. Share capital was FC3 million, translated as 0.5. This means $1.5 million. So we debit away the share capital, $1.5 million. We debit retained earnings, being FC 500,000 times 0.5. This means $250,000. So this is the book value of the net asset. On top of which there has been a fair value increment. Fair value increment is FC 100,000, translated at half. This means we debit building $50,000, and this attract a deferred tax liability, being FC 20,000, translated at half. This means $10,000. So the journal cannot balance because what we pay is more than what we get, and therefore there has been a balancing figure for goodwill. Goodwill is $210,000, essentially the same as what we expect. If we are asked to prepare the consolidated financial statement at the day of acquisition, this is the journal entry that we have to prepare, right? And then we can consolidate in dollar. However, 1 year after, we still need to prepare consolidated financial statements. Now this is 1 year after. 1 year after. How we translate depending on what is the functional currencies of that foreign operation. In this page, we assume that if the functional currencies of this foreign operation is FC, so therefore FC is the functional currency. If FC is the functional currency, goodwill, fair value adjustments, and the book value of the net assets should be recorded in the functional currency, and therefore FC. So therefore, goodwill is actually not $210,000 because goodwill should be recorded in FC. So goodwill should be calculated as 420,000 FC. If it is 420,000 FC, goodwill is an asset. If the functional currency is FC and we want to consolidate in dollar, we have to translate from FC to dollar. In other words, we have to translate from the functional currency to presentation currency. Translation from functional currency to presentation currency, closing rate method applies. So we have to use the closing rate method. If we use the closing rate method, all assets and liabilities should be translated at closing rate. At the day of acquisition, 420,000 FC should be translated using 0.5. This is the situation at the day of acquisition. 1 year after, it should be translated at the closing rate. The question says that the exchange rate on 31st of December 2004 is 1 FC equals to $0.45, and therefore the closing rate is 0.45. Multiplied with 420,000 FC, this means 189,000. In other words, goodwill should be $189,000. But when we prepare this consolidation journal entry, of course, at the day of acquisition, we still prepare the same consolidation journal entry. And after this journal entry, goodwill will be $210,000. In other words, goodwill has been overstated. We must write it down to 189. Therefore, what we should do is we should credit goodwill 21,000. We should credit goodwill 21,000 to bring it down from 210 to 189. When we credit goodwill, we need to debit something. We understand that's why we have to credit goodwill, because this is an exchange difference. Under closing rate method, any exchange difference should go to translation reserve. Therefore, we should debit other comprehensive income, foreign currency translation reserve. So we debit translation reserve, credit goodwill to bring it down. The same for the fair value adjustments. At the day of acquisitions, the fair value adjustments was 100,000 after tax. 0.8 means after tax. We should translate it as 0.5, so that's why this is 40,000 after tax in dollar. Building is a depreciable asset. The question says that this building should be depreciated over 25 years. So this 100,000 should be depreciated over 25 years. That means 4,000 per year. Under closing rate method, usually income and expense will be translated using average rate. So the average rate is 0.48. So 4,000 depreciation translated using average rate. After tax, 1 minus 20% tax rate. So if nothing happens, the closing balance of the fair value adjustments should be $38,464. However, we need to keep goodwill, fair value adjustments, and the book value of the net asset in the functional currencies of the foreign operation. That means in this case, it should be FC. So we keep it in this original currency. So 96,000 FC is the net amount after depreciation. This is the closing balance. Therefore, it should be translated using the closing rate. Closing rate at the year end is 0.45. So 0.45. After tax, 1 minus 20% tax. Therefore, in the balance sheet, in the consolidated balance sheet, it must be 34,560. So therefore, we have to write down the fair value adjustments. To write down the fair value adjustments, again, we need to debit translation reserve. This is the case if the functional currency is FC. The other way around, if the functional currencies of the foreign operation is dollar, that means we should keep everything, goodwill, fair value adjustments, and book value of net assets in dollar because we should denominate it in functional currency. Dollar is a functional currency, but dollar is also our presentation currency. Therefore, there's no need to translate at all because goodwill, $210,000 is the correct denomination of the goodwill. So there should not be any new exchange rate because no need to exchange. It has been denominated in dollar already. This is suitable for our consolidation already. The same for the fair value adjustments. 40,000 is the correct value in dollar. Therefore, it should be depreciated over 25 years. So that's why there's no translation adjustments if the functional currency is already the same as the presentation currency. This is how we translate for the goodwill and fair value differential.